You and Derek moved onto the same street the same summer.
Same month, actually.
You remember because you both had moving trucks blocking the cul-de-sac on the same Saturday, and his wife apologized to your wife about it at the mailbox the following Tuesday. That was the beginning of it.
Same street. Same year.
Same starting line. You were both 31. Both pulling in somewhere around $74,000 a year. You at the County Transit Authority doing operational logistics. Derek in pharmaceutical sales, base salary plus commission that averaged out to roughly the same number when the quarters were good. Neither of you was rich. Neither of you was struggling. You were exactly what the middle of the income distribution looks like when you give it a face and a lawn to mow. That first year, Derek bought a boat. Not a large boat. A used 21-foot bowrider he trailered to the lake on weekends. He talked about it the way some men talk about a second identity. You helped him reverse the trailer into his driveway once because he couldn't quite get the angle right, and he seemed genuinely grateful, the kind of gratitude that comes with a cold soda from the garage refrigerator and 40 minutes of easy conversation in the driveway while the sun went down.
You didn't buy a boat.
You bought a duplex 6 blocks from your mother's house for $112,000. The tenant in the upper unit had been there for 3 years already. She paid $725 a month. After the mortgage payment, insurance and a small maintenance reserve, you cleared $190 a month. Net. Before anything broke. Nobody congratulated you on the duplex. Derek's boat got more conversation at the block party that August than any financial decision you made that decade. That ratio stayed consistent for a long time. 20 years is a long span to compress into a single story, but the shape of it is simpler than it sounds, because the shape of it was determined mostly in the first 3 years. Not by income or luck or some information one of you had that the other didn't. By a single operating assumption that you each made separately, without ever naming it out loud. Derek's assumption was that financial progress should feel like financial progress. The evidence of building something should be visible, drivable, wearable, and available for comment at a neighborhood gathering. Your assumption was different. You weren't sure you could articulate it cleanly back then. It was less a philosophy than an instinct. If the asset doesn't produce something while you're not looking at it, it's a liability wearing a different shirt. The boat was a liability. Not because boats are inherently wrong. Because that particular boat sat in that particular driveway 11 months out of the year and generated nothing except maintenance costs, storage fees, registration renewals, and the steady low-grade obligation to use it enough to justify the story Derek had built around owning it. The duplex sat 6 blocks from your mother's house and generated $190 a month whether you thought about it or not. A lot of people go their whole financial lives without ever making that distinction. By year 4, your tenant in the upper unit had moved out and you spent 3 weeks anxious about vacancy before finding a young couple who paid $850 and kept the place cleaner than the previous occupant had. The anxiety of those 3 weeks was real. You thought about it at work. You did the math on what a 2-month gap would cost and it wasn't catastrophic, but it wasn't comfortable either. It reminded you that a duplex with one tenant is a concentrated position, and a concentrated position is a risk you can price. You bought a second property. A single-family rental, a 3-bedroom Cape Cod on a corner lot about 12 minutes from your house. The seller was an estate, the family wanted it gone. You paid $94,000. The market rent was $1,050. After carrying costs, you cleared just under $300 a month. Derek refinanced his primary mortgage that same year and used the equity to put a finished basement in his house.
It looked good.
It genuinely looked good. His kids had a space down there with built-in shelving and a sectional sofa and a television mounted at the right height. His wife was happy with it.
He was happy with it.
It cost him $38,000 and added roughly $22,000 in appraised value to a home he had no current plans to sell. You didn't say anything about this.
It wasn't your place.
But you noted the spread. The part of this story that doesn't get told often enough is the middle. Not the beginning, where someone makes a smart first move and feels quietly clever about it. Not the end, where the numbers reveal themselves and everyone nods. The middle is where the real information lives, and the middle is mostly just maintenance. Your maintenance was literal. You drove to your rental properties on weekends and dealt with slow drains and cracked weather stripping and a water heater that failed on a February Thursday night and required a plumber at a rate you didn't enjoy paying. You built a small reserve account specifically for this because you'd read enough to know that deferred maintenance is a future emergency with a calendar on its face. You were not glamorous about any of this. No moment of clarity, no pivot, no breakthrough. Just a guy in his mid-30s driving a Honda CR-V to a Cape Cod on a corner lot to check on a repair his tenant had mentioned twice, before it became something larger. Derek was not idle in this period. He was genuinely working hard. His commission structure had changed and he was running harder to hit the same numbers, which meant longer drives, more overnight trips, a particular quality of exhaustion that builds when your income requires constant personal output to sustain it.
He upgraded his car.
He needed something reliable for the mileage. He picked up a new truck at $58,000, financed over 72 months. The truck required him to keep selling at a level that justified the payment. The payment required the truck to keep covering the territory. The territory required the fuel. The fuel required the reimbursement, which came in quarterly and always ran slightly behind what the receipts suggested it should. That is what earned income looks like structurally. It runs when you run. It pauses when you pause. It has no mechanism for rest that doesn't also pause the revenue.
Year 9.
You have 4 rental units across 3 properties. Combined gross rent of just under $4,200 a month. After all carrying costs, your net is approximately $1,800 a month, $21,600 a year coming in from assets you purchased with money you'd already earned and invested instead of spent. Derek's salary has grown. His base is now $88,000, and good quarters push him to $105,000. He earns more than you on paper, on the line of a tax return where you write in your wages. But his financial life is structurally identical to what it was in year 1. Every dollar he has earned in 9 years has required Derek Paulson, specifically, to show up somewhere, make a case for something, and close a transaction.
The moment Derek stops, the income stops. Not slowly. Immediately.
You both know this. You've never discussed it, because there's no version of that conversation that is comfortable for either of you. But you've seen it in the way he talks about his job, a particular tightness around the edges of sentences that involves the word restructuring and a regional manager who has been making noises about quotas. His youngest had a medical situation that year. Serious enough to require a specialist and 2 weeks of follow-up. Nothing catastrophic in the end, but expensive in ways insurance covers imperfectly. It hit his savings hard. Not ruinously. But you could tell, the way you can tell with someone you've known for 9 years, that the margin was thinner than it had appeared from the outside. Your rental income didn't notice. It deposited on the first of the month, same as always. By year 14 you had made a move that felt large at the time. A small commercial property, 4 retail units on a secondary road in a town about 20 minutes east. 2 of the 4 units had long-term tenants, a tax preparation office and a physical therapy practice. The other 2 were vacant. You bought it at a price that reflected the vacancy and spent 7 months finding tenants for the remaining units, which was uncomfortable in the specific way that commercial leasing is uncomfortable. It required patience on a timeline that felt deeply inconvenient. By the time both units were leased, the property was generating $6,400 a month gross. After the mortgage, taxes, insurance, property management fees, and a maintenance reserve, the net came to approximately $2,900 a month.
More in good months.
A little less when a repair surfaced. Your accountant, a methodical woman named Patricia who kept impeccably organized files and expressed enthusiasm through the absence of concern, looked at your portfolio summary that year and said it was unusually straightforward for someone of your age. She meant it as a neutral observation. You took it as exactly the right thing to be. Derek had started a side business. A pressure washing operation he ran on weekends with equipment he'd financed on a personal line of credit. The business had real potential, good demand, decent margins if you controlled your time. He did about $18,000 in revenue in his first year and spent approximately $14,000 operating it, including the equipment note, fuel, supplies, and 2 weekends of repairs to a machine that should have had a better maintenance history before he bought it. He wasn't wrong to try. The instinct was correct. But the execution had the same architecture as everything else in his financial life. It required Derek. Every dollar of it required Derek standing in someone's driveway with a wand in his hand at 7 on a Saturday morning. He ran it for 3 years and then stopped. The job had gotten more demanding and something had to give. He sold the equipment at a loss and the line of credit sat on his balance sheet for another 18 months.
Year 17. You do not tell people what you own.
Not your neighbors, not the couple from the street you see at school events, not Derek, who has been your neighbor for 17 years and who you genuinely like. He helped you carry a refrigerator down a flight of stairs once and asked nothing in return. His kid shoveled your driveway without being asked the winter your back was bad. These are not small things. But your financial life is not a topic of the neighborhood and you have made sure of that consistently, the way you maintain a useful habit, not dramatically, not with obvious effort, just continuously. You drive a used Camry. It is 6 years old and has no particular defects. You bought it for cash. Derek drives a lease Tahoe because the lease math worked better than ownership given his current situation, which is a reasonable calculation if you accept the premise that you will always need a vehicle at roughly that payment level. That premise is worth examining. Your house looks like every other house on the street. You painted it 2 years ago.
The gutters are clean.
The landscaping is maintained but not elaborate. Nothing about it suggests anything one way or another. Derek's house has a new roof, new windows, and a kitchen renovation completed last spring. It looks genuinely beautiful. His wife sent photos to her sister in another state and the sister said it looked like a magazine. The renovation cost $67,000, financed on a home equity line at a rate that, over the 15-year term they're likely to actually carry it, will cost them close to $104,000 total. The kitchen generates nothing. It is a beautiful, expensive room the family eats in, adding perhaps $30,000 to $35,000 in resale value to a home with no current sell date. You do not say any of this. You told his wife it looked wonderful when she showed you the photos at her front door, and you meant it sincerely. It does look wonderful. That has nothing to do with whether it was the right use of $67,000.
Year 20.
There is a block gathering in late August. The Hendersons are moving, and someone suggested a send-off in the cul-de-sac with a card table and a sheet cake from the grocery store. The kind of gathering that happens on streets like this, ordinary, warm, unremarkable in a way that is actually worth something. You are standing near the edge of the driveway with a plate in your hand when Derek comes over. You talk about the Hendersons and about the fall and about whether the township is going to repave the back section of the street this year or push it to next budget cycle. Normal conversation, the kind that requires nothing from either of you except presence. At some point he says, unprompted, that he has been thinking about retirement. That his company has been going through changes. That he is 51 and the math on retiring at 65 is looking more complicated than it appeared at 31, mostly because the retirement accounts grew slower than the expenses required to maintain the life he built. He says this plainly, without self-pity, the way someone states an operational problem rather than a personal failure.
You listen.
You don't offer anything except the attentiveness of someone genuinely paying attention. In your head, you are doing a different kind of math. Your rental portfolio generates approximately $9,400 a month in net income. The commercial property alone clears $2,900 on a median month. Your primary mortgage has been paid off for 4 years. Your total passive income, the income that arrives whether you work or not, whether you show up or not, whether your employer restructures or doesn't, exceeds your original salary from year one by a margin you've stopped finding remarkable because it accumulated gradually enough that the transition from remarkable to ordinary was almost invisible while it happened. You could retire right now. You could have retired 3 years ago. Not in luxury, not in a way that removes all constraint, but in a way that is structurally sound and permanently detached from the requirement that you personally produce every dollar that enters your household. You do not tell Derek this. There is no world in which telling him this serves either of you. You tell him the paving timeline is probably next fiscal year based on how the last 2 cycles went, and that the Hendersons' address at the new place is on the card if he wants to stay in touch.
He nods. He finishes his cake.
He goes to talk to someone else.
20 years.
Same street, same starting line, same income range for the first decade. The gap between you now is not a story about talent.
Derek worked hard. Derek showed up.
Derek made decisions that were individually defensible every single time he made them.
The boat was fun.
The basement was useful. The truck was necessary for the job. The kitchen is beautiful. None of it was reckless. All of it was normal. The entire story of Derek's finances is the story of normal. The duplex wasn't glamorous. The Cape Cod on the corner wasn't a conversation piece. The commercial strip on the secondary road didn't make anyone look twice. None of it generated a story worth telling at a block party, which is exactly why it accumulated quietly for 20 years without interruption. The difference between you isn't the income. It's what you understood the income to be for. Derek understood it as the point. The income came in, supported the life, signaled the level. When it grew, the life grew with it. When it plateaued, the life did too. The two moved together in direct proportion, always. You understood it as raw material. The thing you turned into something that didn't need your continued presence to function. Not without gaps, repairs, vacancies, and February plumbing emergencies. But structurally, in the way that matters when you're 51 and doing the math at a block gathering in late August, the architecture holds. Patricia, your accountant, sent the annual summary in September. 12-point font, no exclamation marks, same formatting she has used for 19 years. You read it at your kitchen table on a Sunday morning with the window open. The number at the bottom of the net worth column has more digits in it than Derek or most people on this street would believe if you said it out loud, which you will never do. You sit with it for a few minutes. Not with pride exactly. Something quieter than that. Something that doesn't need an audience to exist. Outside, Derek's Tahoe pulls out of the driveway. His kids are older now. He is probably driving somewhere for something that requires his presence.
He will come back later. The house will be there.
The kitchen will look beautiful in the afternoon light. His family will eat dinner in it and it will be good and real and worth something no spreadsheet can quantify. You close the summary. There's a water heater at the Cape Cod the tenant mentioned is making a sound it didn't used to make. You want to get ahead of it before it becomes an emergency. You get in the Camry. The road is the same road it has always been. The crack in the curb where the oak root pushed through has been there for 6 years and the township still hasn't addressed it.
Same street. Same surface.
Underneath, everything is different.